We have Ted Tsiakopoulos. He's the senior economist and specialist of housing markets policy and research at CMHC. Good morning, Ted. How are you today?
Good morning, Brian. Thank you. I'm doing well.
That's great. So we have a jam-packed 45-minute session today. Maybe a little bit less, maybe a little bit more, depending on time. But what we're really doing is we really want to give some insights around what's taking place in the housing market and really start to share what is taking place. COVID-19, there's lots we're not aware of and how the housing market is going to perform. So what we really want to do is take the time today. My name is Brian Bell. I'm the president and broker of record of Giraffe Realty, and we're a brand new real estate brokerage, and we're a B2B based company. And we really are about doing three things within the marketplace. First and foremost, we're education. We're really spirited around finding good ways to educate clients in the buying, the selling, and really the renting side. Data, we're a data company. Behind the scenes, we've built out some really good data, which we'll show you towards the end of the presentation. And innovation, we have a whole bunch of new innovative programs that we're launching in the coming months. So today, Ted was kind enough to take some time. He's going to walk us through some slides today. He's going to take us through and really give us an overview of the housing market. Ted and I have spent some time with really talking about how do we put this crisis into perspective and looking at it from a historical perspective. And Ted has done a really nice job of doing that for us. He's going to tell us what some of the latest numbers look like in April and May. What I really love about Ted is he gives such good insights. So he's going to really talk to, hey, as the average everyday mortgage banker, appraiser, even realtors, how do we start to look at the information that's being given to us in the marketplace and really be able to digest it and help with our clients? And then I'll close today's presentation with some insights around the housing market. I actually was able to pull data directly from our database that shows us the first 8 days of June. So I'll be able to say, where do we think the month of June is going to end up after Ted has given us and shared these insights with us. So with that, I am going to turn it over to Ted, and we will let Ted take the reins. Good morning, Ted.
Good morning, Brian. Thank you.
So Ted and I, just to give you a sense of the background, Ted and I used to work together. My very first job was with CMHC, and I had the pleasure of working with Ted. We both worked as housing market analysts. Ted is such a phenomenal presenter. He is so educated and smart about the housing market, and it's a real pleasure having you. So over to you, Ted.
Thank you, Brian. Thanks. Yeah, I remember that used to be a long time ago.
Just 2 years.
A couple years ago. Well, I guess we connected again at Carson Dunlop about a decade ago. That was an interesting event. But let me just set this up, and hopefully I don't mess things up here. One sec here. Okay. Let's see. You've given me control here, right? Is that?
Yep. So while we wait for Ted, if you guys have any questions, we're going to leave about 15 minutes open at the end. So use the chat area, put your questions in as we're going along. As you come up with different questions, away we go, and we will be able to do it. Right on the bottom is a share, Ted.
Hold on one sec here. For some reason, I don't see the.
There you go.
Okay, perfect. Let me put it screen. Full screen here. Slideshow from beginning. All right. How does that look? Is that okay or?
Yeah, it's fine. Perfect.
Okay. So thank you very much to everyone for taking the time to be here today. I know you're all quite busy, and it's just been a crazy roller coaster ride, I'm sure, for everyone. The title of my presentation is in some ways funky and maybe a bit strange, maybe interesting. When I look back at the last 5 years, and by the way, we're going to be going back a lot more than 5 years, but things have changed so dramatically. So we've gone from FOMO, for those of you who know what FOMO is, the fear of missing out, which seemed to be rampant back in 2015. The average Canadian wanted a piece of real estate and was willing to pay any price for it. And for most, it turned out well. For some, not so well. Over half of Canadians were paying more than budget for that home they purchased, got into debt. But you know, we fast forward to today and we're talking about FOGO, the fear of going out, and how this pandemic has really ravaged industries across the global economy. And real estate has not been immune to this either. So from FOMO, we've gone to FOGO, and now we're going to, and I've got two question marks here because, to be quite frank, I don't think anyone has a good grasp. Nobody has a crystal ball, including myself. It's really, we have no playbook for this. It's really an unusual time. So I'm just going to walk you through some of my thoughts. Some logistical stuff here. We have released our national and provincial outlook. So that report is online. We'll try to send it out to everyone who's registered after this event. The plan is that we're going to be releasing our forecast for Toronto, Vancouver, and Montreal at the end of June. So stay tuned for that. So today I'm going to be highlighting some of the provincial numbers in Ontario, and you'll be able to extrapolate what this probably means for the biggest city in the province, the GTA. So some key takeaways here. Something that hasn't been getting any kind of ink is the economy in the back half of 2019. The reality is that the economy was losing momentum, and in some ways was running on fumes. So it was only a matter of time before we would see this spill into real estate, despite the fact that real estate entered 2020 like a lion, more like a lion than a lamb. But essentially, the economy was running on fumes in the back half of 2019. And when I say running on fumes, GDP is what I'm focusing on here. The job market was still very strong, but as you know, jobs, the economy more generally and how it's growing matters for jobs. And essentially, we would have seen some kind of moderation effect at some point in late 2020, early 2021, but it came a little earlier with COVID. And when the economy takes a hit, when we see a demand and supply shock of this magnitude, sales in the housing market also are impacted. And in some ways now we're running at about 40 to 50% of capacity in the Greater Toronto Area in terms of where sales were early this year or across time. And markets that are thinly traded, and you may have come across this term if you've dabbled in the stock market at all. It just means that with sales being at 50% of capacity, there's a lot of volatility and a lot of uncertainty. And so a scenario approach is quite ideal. And you may have heard a lot of economists turn to scenarios in trying to explain the future. And there's good reason for that. Again, a lot of it is tied to how thinly traded these markets are, how volatile they are. So two scenarios that we've generated. There's a high scenario, or what we call the upper bound of our forecast, and this implies a U-shaped recovery. So typically, what this means is that everything goes back to normal. The economy is unlocked. Employers hire workers back. There's no second wave of the pandemic, and everything just goes back to where it was. And so this kind of scenario actually mirrors what we saw during the 2008-2009 great financial crisis, how we came out of that recovery. This is what the scenario sort of resembles. We also developed a low scenario, not as optimistic, more of an L-shaped recovery. And if you're wondering what this sort of resembles, it resembles what we saw in the early to mid 1990s, a very, very slow recovery, okay? And so, what gives rise to this kind of scenario? Well, again, if we have to lock the economy up again because we get the second wave, that could push more businesses into bankruptcy. For sure, the unemployment rate will continue to move up, and we could see foreclosures and more supply flowing onto the market. And of course, that's never good for house prices. So 2 scenarios that we've developed. Where does the truth lie? Well, sometimes the truth lies in the middle, or at some point between these 2 scenarios, or could be any one of these scenarios. But generally speaking, in the low scenario, which is our pessimistic scenario, we've got prices dropping as much as 18% from peak to trough. For the country, for Toronto, probably, well, for Ontario, probably a little more than that, not much more. But I think I want to stress the point that this is a drop from peak to trough. This is not the same as what the average annual price will be growing or slowing by from 2020 to 2019. In fact, even in either the high or low scenarios, because we entered 2020 like a lion, we're actually probably going to see some growth on an average annual basis. When we take average annual numbers for prices, at least, we will see some growth. So I just wanted to make sure that we understand peak to trough, average annual. Okay, those are 2 different things. And there has been some light at the end of the tunnel here. I don't want to create an overly pessimistic scenario. Recently, we've seen the financial, labor market, housing data point to some optimism. If you follow financial markets, and if you believe in the predictive power of financial markets in some way, like I do, we've started to see some money flowing out of flight to safety assets, and that's great news. So money flowing out of the US dollar, out of gold, out of bonds. That suggests that there is some optimism coming back. Labor market numbers in May, pretty strong. Having said that, we've only recovered about 10% of the jobs we've lost in the last few months, but we'll take it. May job numbers up strongly in Canada and the United States. And of course, the May housing numbers weren't all that bad. Sales growing by over 50% in the GTA, and prices growing by about 5%. So this suggests that we're going to see a mild recovery through the summer, but it's going to be very bumpy, and we probably won't see a sustainable housing recovery until the middle part of 2021. And the rental market, the recovery there will take a lot longer, because we see a harder hit to the rental market given the closing of the borders and what it means for immigration, as well as the lockdown and the effect on jobs, particularly for mid to lower income households. So there's been a lot of stuff that's been floating in the media, and I just wanted to highlight this very quickly. Are these factual statements or fictional statements? Peak to trough price forecast is not a valuable metric. Boy, oh boy, I've heard that enough times to last a lifetime. I would disagree with that. You obviously guessed I would disagree with that. And I'll tell you why. If you're a homeowner who bought 20 years ago, then maybe the peak to trough forecast of prices doesn't have any meaning to you. You've been in the market for a long time. You're not impacted by this 8% drop in GTA house prices since February of this year, or our forecast of as much as a 9 to 18% drop. However, if you bought at the end of last year, or you bought at the beginning of this year, then peak to trough matters for you, right? For obvious reasons. You have no history in the market, you have no equity, and so this measure adds additional value. The other fictionals, well, semi-fictional. I want to give it some credit. Here's another statement that's been made. Homeowners will not drop their list price, so there will be no negative price impact. Yes, that may be true in normal economic times. And that's what makes real estate a bit different than stocks or equities as an asset class. It's that homeowners in normal economic times, if they don't like the price that their home is fetching, they can take that listing off the market, and prices prices don't adjust, they stay where they are in normal times. But in not so normal times, like the times we're living right now, if your income has taken a hit, if there's been some disruption there, or if you've lost your job and you have to sell, you better believe you're going to be adjusting that list price down. And the best example I can give is what we're seeing in the rental market today, where landlords are reducing their asking rents, and they are doing that for good reason. Prices can't drop further since CREA's housing price index, which is really a quality adjusted price index, is still rising. I'll show you that that's also not true. That in fact, the HPI, which is a better measure of real price, because it is quality adjusted, we're measuring the how prices for apples to apple homes is moving. I'll show you over time how that follows the sales to new listings ratio quite closely, and it follows the MLS broader market price quite closely. Mortgage rule changes will have only a net mortgage rule changes will not have, sorry, this is a bit of a typo. Mortgage rule changes will not have a negative impact on the market. Well, sorry, again. Mortgage rule changes will have only a negative impact on the market. I had to look at this a third time. It is correct. It is worded correctly. So in other words, mortgage rule changes will be negative. There's no positive impact. And in fact, nothing could be further from the truth. In fact, our analysis shows that any change to mortgage rules that restrains the growth in debt, that restrains loan-to-value ratios, that restrains GDS and TDS ratios, in other words, keeps them from continuing to grow or maybe even pushes them down, is actually quite stabilizing. Very stabilizing longer term for house prices. So if you're a lender, if you're a realtor, that's good news. So let's put our forecast, the high and low scenario, into context. And what I'm showing you here, and I pulled this table from a report that we published 2 years ago. And what we did there is we went back to the 1960s and we looked at all of the most serious house price corrections in the housing market. And we call these house price bust periods. Bust being a more serious correction, sort of synonymous with a bear market in stocks, where we've had prices drop for 4 quarters consecutively and dropped at least 10% in real terms. So we were just looking at the most serious declines in house prices across the GTA. And you can see the 5 bust periods we identified, what the average duration was in terms of quarters, 8, so that's 2 years, that downturn lasted for. And on average, those prices dropped by 19%. So if you were to, from peak to trough, if you were to create this nominal equivalent to 19%, it would be well over 25% drop. So we've had some serious downturns that have lasted on average 2 years. And what we're saying is that in both the high and low scenario, we could be seeing a recovery as early as 4 quarters. So obviously, even when looking at the most serious downturns, the one that we're predicting here, probably not as serious. And so just to put some of our numbers in perspective, because there have been a few out there that have suggested our forecast is alarmist, is irresponsible, but yet let the data speak for itself. Let the evidence speak. And I'm showing you what the evidence shows historically. So, we can't compare apples to apples, or all periods are not the same. History doesn't always repeat itself the same way. But I have some hope that with all the stimulus, both fiscal and monetary, with the fact that this was a health epidemic that hit the economy and the real estate market, that if a vaccine is found, that we could certainly avoid some of the more serious price bust periods that we've seen historically. And what were the major triggers for these house price bust periods? There were 3 major ones that we identified. Was the market overvalued? Was the economy contracting? And was there a housing policy shock of some sort? So these were really three very important triggers of the more serious house price bust periods we've seen. And so what combination of triggers yields a more serious downturn in house prices? Well, when you have all three triggers present. So that condition B that I highlight here in the Venn diagram assumes that you've got all three triggers at play. They're live, they're having an impact. So you've got overvaluation, you've got a housing policy shock, and you've got the economy contracting. And, you know, I was too young to really remember too much from the 1960s and 70s, but I can certainly read data. I understand data. And condition B, I think we saw back in the mid 70s, for those of you who remember the mid 70s, because not only did we have a market that was overvalued, but the economy was in a recession, and you know there was a policy shock in the city of Toronto. Just going by memory here, the mayor actually proposed increasing the capital gains inclusion rate, which is not the right thing to do. So generally your capital inclusion rate, capital gains, is, you know, what percentage of my stock market gains and real estate gains are subject to taxation. And the mayor at the time was pushing those inclusion rates up. So all of these factors were actually having a devastating impact. Where are we today? I would say combination A is probably more indicative of where we are today, which is one of the reasons why I think we'll avoid one of the more serious downturns that we've seen over history, you know, moving forward. So combination A probably mirrors where we're at. Moving forward, what metrics should we watch if we're in the industry and we're advising our clients? Continue keeping your eye on the economy, GDP. We really need to see growth come back. We need to see full-time employment come back for obvious reasons. If people have a job, they have the willingness and the ability to buy a home. All very important factors for lenders providing mortgage financing. And how we try to capture both is by looking at the yield curve and the spread between long and short-term rates. Besides all the macroeconomic models we have in-house, a very simple metric like the yield curve, I probably live and die by. It's a phenomenal predictive indicator of where things are going. Another metric is overvaluation. While the market today is clearly not as overvalued as it was back in over the 2015-2017 period, there is some overvaluation there, and clearly with incomes taking a hit because of the downturn in the economy, you know, basically following this metric is quite important. And we do publish numbers on overvaluation, are thinking about overvaluation every quarter, so keep your eye on that. Obviously, consumer confidence, very important. Consumer confidence indicators are not a very robust currently. So whether you're looking at the conference board numbers or the Nanos numbers that were just released a couple days ago, or other indicators, consumer confidence is quite low at this moment, and we really need to see this turn around as well. So keep your eyes on that. House price expectations, very important as well. Traditionally, Toronto and Ontario residents set their expectations on where house prices are going by looking backwards, so looking to history to guide them. So they use a more adaptive approach. So if historically average annual prices were growing by 5% across the GTA, 5 to 6%, which is a fairly good indication of reality, they will extrapolate that into the future. And so price expectations are again have taken a bit of a hit, so we really need to see some move up there. And sales to new listings ratio, really the balance between demand and supply. That's another metric to keep your eye on, because it's again has a lot of predictive power for house prices. Quality adjusted price metrics, An example would be Korea's HPI. National Bank Ternet also release a quality adjusted price index. Also a nice index to look at. I'll show you that in a moment. And you're probably wondering, why has this made the list? September, October resale data. You know, with all this noise in the data, I would say keep your eye on September and October. Those 2 months have gained in importance in terms of impacting the annual number in terms of house sales and prices, where that annual number will end up at. And you know, you shouldn't be surprised by this, because over the last couple of years, you may know that a lot of activity has shifted out of the spring summer market into the fall. You know, we've seen, we don't have a spring market anymore. It's kind of spread out through the year, and September and October have gained prominence, have increased their weighting in terms of their impact on the annual number. So keep your eye on September and October. That'll give us a sense of whether we'll be exiting this year like a lion or like a lamb. And it really will paint a picture of what 2021 will look like. So keep your eyes on that. So where are some of these metrics at currently? That's what I'm showing you right here. I'm also providing you a risk rating for each of these metrics based on is there low risk to house prices? Is there more moderate risk to house prices? Or is there a high risk that prices could correct, you know, in a sharp way? Could be like, we could see what I called a price bust period. And so the current risk is really what the current data is telling us. And so I've color coded a lot of these metrics and given an overall assessment here of the market. And you can see here that we've got a mix of colors here. We've got some yellow, which is more moderate risk to house prices. And clearly price expectations and the sales to new listings ratio is in the sort of moderate risk rating right now. But we also have some red, right? We have the economy contracting, and the yield curve tells us that things haven't changed there. That yield curve is still inverted or flat. Consumer confidence still quite low, so high risk here. And then you've got this blended yellow-green, which I guess in some ways is better than a yellow, where we're at a low to moderate risk level for both overvaluation and mortgage regulations. And you're wondering, well, Ted, why are you giving a low to moderate risk rating for some of the mortgage regulation, mortgage rule changes that we've seen? And it goes back to my earlier point that over longer periods of time, the benefits outweigh the short-term cost, by no question about it. In terms of managing debt, in terms of managing the risk to the financial system, in terms of risk to the taxpayer, in terms of, again, managing the hit to house prices. So regulations that restrain loan-to-value and debt ratios and GDS ratios is actually quite stabilizing for house prices. So earlier I showed you some fictional statements, a number of statements out there circulating that suggest that, hey, the HPI index is still pointing up, so it can't be all that bad. Why are you guys calling for a low scenario? Why should we even consider one? And what I'm showing you here is why the sales to new listings ratio is such a great leading indicator, and how prices react to it with a lag. And so in orange, you see the Korea HPI here, the year-over-year percentage change in the quality adjusted Toronto HPI index. In blue, I'm showing you the sales to new listings ratio, the change year-over-year over time. And in green, I'm showing you the Toronto overall MLS price as it's reported by the Toronto Real Estate Board. And you can see here that when the sales to new listings ratio drops, and during bad economic times, you could see as much of a 40% drop in the sales to new listings ratio. By the way, I'm using the left scale here for the well, I'm using, the left scale is being used for all variables here, but you can see here in 08, almost a 40%, just over a 40% drop in that ratio. Um, and then we had another dip closer to 2010. During the 2016, 2017 market adjustment, you see another almost drop of about 40%. In both instances, you could see that house prices reacted in a negative way, both MLS price and Korea HPI, right? In the 2017 period, you see a very similar picture. The TREB MLS price reacts first, and Korea's HPI reacts with a lag. So in this current period, we've seen the Toronto MLS price off about, I'd say, 8% since early this year. Where is that HPI headed based on history? You know what I'm betting on here. Probably not as big of a adjustment as we've seen in history, but certainly there is that high probability that it could turn down as that sales to new listings ratio moves lower. Now, it really keep your eye on that sales to new listings ratio, because if it drops and continues to break through what I showed you on the previous slide, if it continues to break through this 40% range, where, you know, if 10 new listings flow onto the market, less than 4 of those new listings are sold, then you're in a buyer's market. That's a high risk market, as I've noted here in the third column, and prices will follow that sales to new listings ratio lower. So again, all to say here, don't take your eye off of some of these indicators, because they all have meaning. A word about when we drill down by house type, where will house prices hold up better? You know, I think the demand-supply ratio favors low-rise home prices moving through the next 12 to 24 months. So why do I say this? Well, what I'm showing you to the left here in orange is the year-over-year change in the single detached home price, okay? And I'm using Korea's HPI. And in blue, I'm showing you the year-over-year change in condo prices. And you can see the period between 2010 and 2017 was really a period where single detached prices were driving the average. So you can see here, year-over-year, singles, low-rise, were growing much faster than condos. But that shifted post-2017. As the market became less affordable, demand started to shift to condominiums. And you can see here, year-over-year, condominiums have been outpacing singles from a growth perspective quite substantially. So much so that that gap between single prices and condo prices in the GTA has narrowed. So moving forward, I think there is more value in the low-rise segment of the market than there is in the high-rise condo segment. Some headwinds for condos include things like more condo completions expected over the next 12 to 24 months, include evidence that investors are slowly exiting the condo market and have been exiting, I would argue, since 2017. And more importantly, for singles, we've just got a shortage of single-family homes entering the market. We're not building enough single-family homes. So it's just some factors here. Supply not keeping up with demand, especially for low-rise housing. We've got some land use regulations, some restrictions regarding zoning. Development approval times are only getting longer, and that is reducing the timeliness of new single-family homes hitting the market. We've also got an aging population that's living longer. That's what the mortality numbers are telling us. Aging households are less mobile. They like to age in place. And you can only imagine with more younger households perhaps looking for single-family homes, with few aging households moving, that's creating some frictions. Again, sort of contributing to this notion that single-family prices probably, likely, maybe holding up better over the next 12 to 24 months. And CMHC, you know, we're committed to boosting supply. There's all kinds of measures we have in place to do that. I'm part of a team that's working with the province and with the municipalities to expedite their planning approval process, to change the way they're thinking about zoning, and to show and demonstrate that if you change zoning in a productive way, that could make all the difference in getting more homes on the market in a timely fashion, especially homes that people need and want and meets their needs. So that sort of missing middle kind of density that we need. So I talked a little bit about singles and condos. How about rental? What can we expect? And I'm watching the time. This is my last slide. Well, what are the triggers, if you like, or the metrics that we should be looking at to guide us on where the rental market is going? So the economy, more specifically the unemployment rate, critical, fantastic leading indicator. And secondly, net international migration. So on the demand side, these are the two metrics I would be keeping my eyes on, because you could see here, when we start with the economy, you could see what a change in the unemployment rate historically has meant for vacancy rates. And for those of you who may not know this, rental is very pro-cyclical. What does that mean? It means that when the economy is growing, we're creating jobs, and the unemployment rate is moving down, it's likely the case that the vacancy rate will also move lower as more residents feel confident about their job prospects, pushing them to form a renter household. And that tends to put downward pressure on the rental vacancy rate. And history doesn't lie. You can see the data here. If we move to immigration, international migration, critical, because we know that 2/3 of immigrants that first arrive in Canada don't buy ownership housing. They move into rental, 2/3. And you can see when immigration is growing over history, what impact it has on rental vacancy rates. So keep your eye on those two metrics. I suspect both metrics over the next 12 to 24 months will exert upward pressure on Toronto rental vacancy rates, and we're already seeing signs of that as landlords adjust their asking rents lower. On the supply side for rental, as I mentioned a bit earlier, we are expecting more purpose-built rental units to be completed. So that should add to supply pressures. At the same time, we also know that Airbnb, some of those units are flowing into the long-term rental space. So again, the demand-supply ratio for rental is favoring tenants more so than it's favoring landlords over the next 12 to 24 months, resulting in probably higher vacancy rates and lower rents. So that's it for me. Thank you for your time, and I'll switch it over to Brian. Thank you.
Ted, thanks very much. Really, really great insights. If you turn the screen over to me, what I will do, so wouldn't be a good friend to Ted unless I put him on the spot a little bit today. So we'll put Ted on the hot seat. But what I did was at Giraffe Realty, we built out a full database on the Toronto Real Estate Board information in order to help our clients. I actually snapped the database this morning to actually see what is June doing this year in comparison to last month and last year. So I'm going to actually show us what's happening because it's going to give us some very good insights around the market. What's really neat is when we look at June of 20, so on the left-hand side of the screen, you'll see we're comparing June 2020 to June 2019, and that's only the first 8 days of the month. So the really good news story that we're seeing about listings right now is that listings when compared to last year, only in the first 8 days, are only down just 10%. That's a dramatic change, and we're seeing some advancement. So we're seeing that the residential, and Ted talked to it in his summary, we've seen the number of listings for residential being down, the number of condos is up. That is not a surprising trend that we're seeing because of this Airbnb effect and more rentals that are now actually being put onto the market for sale. When we were quite pleased within the housing market as it related to the May numbers. We all thought, geez, it looks like we're directionally moving better. When we looked this morning, the actual number of listings is double what we've seen in the first 8 days of the month in comparison to the month of May. So June, we are flying already with the number of listings hitting the marketplace. So pretty big trend, pretty big insights around what the market is actually doing, which we're happy to see that the numbers of listings have increased. When we look at the number of sales, and the slide on the left, or the left-hand side with the chart, that actually shows our year-to-date. So this shows us right up until June the 8th, as of yesterday. We know that our total sales are down 24.2% in general. What's the exciting part is really looking on the right-hand side is how are we trending when we look at that month of May, which we were pleased with. And we've seen that condos is down slightly. They will catch up. Remember, the numbers are relatively small. Just on average and directionally, in terms of the number of sales, we're basically 2.5% ahead of where we were last month. So from a GTA market listing perspective, we're seeing a massive amount of new listings coming on from the previous month of May. We've also seen an increase in the number of sales as we look to it. We like to, and same with Ted, I've been very fortunate as we built out our data in our company. Ted's been very kind to help us with a lot of our data and our metrics to make sure that we really get a good understanding. And what I wanted to do is kind of see what is going on and with the marketplace. I only grabbed 3 because they're the ones that really give us good indication. So days on market, if we look from May 8th and compare that to June 8th of the first 8 days, we're seeing that the actual days on market for houses is compressing or going down. So that's showing us that the real estate market is heating up. So we're now starting to see homes are sitting on the market in less time than they did into that previous month. The sale to listing price is a critical one. So I list my house for $100. Historically, we've seen the market has been at 98 to 99% of what you actually get as your sales price. So it's called your sale to your list price. In the month of May, it actually was below our average that we've seen for most months at 98.5. We're watching it creep up, and a lot of this has been in the downtown Toronto market where we're seeing. We are watching the suburbs, being the Oakvilles, the 905 areas. They're all under 100%, but it's this GTA phenomenon that's really driving that 100.3%. So we may start to see it, and there's a big differential when we look at residential to condo. Ted was 110% correct in that the condo effect is with a number of listings coming on, we're going to see the sales to list price in the month of June for condos start to drop. So they're not going to be getting that full number that they were looking at. And just looking at the last one, which is the average price. So we're watching average price starting to creep up as well. Remember, it's a small data set, but it's directionally telling us that homes are selling quicker, homes are actually selling at a higher price, and they're moving fast. So those are the numbers that we've been able to see in the GTA. We have a lot more data, but this gives us the forecasting ability to see what is the market doing, how is it responding and doing. So on a monthly basis, Giraffe Realty is actually going to be issuing monthly reports that we'll be sharing with our partners around what is the sales to new listing price, how does it relate into the housing market. So we are pushing hard to really drive data and insights to help our lenders, our partners, and our clients that actually buy the real estate understand market conditions and where the market is going. So with that, we'll leave it to questions. You can unmute yourself. Ted, I thought you did a phenomenal job today, really sharing some good insights around how do we look at the market, because there's so much doom and gloom that it's helpful to get your perspective. And I think the ability for our brokerage to share some of the June numbers definitely puts a positive spin on where I think the market's going. Ted, do you have any comments on the slides that we had presented that you've seen?
No, I only to say that I share your feeling that we will likely see a mild recovery through the summer, but I would look even beyond the summer months and really pay attention to September and October. I think those months will be telling for us where we're going, and I think the fall will be telling. So, yeah.
So we'll leave it open. Anybody that wants to unmute to ask a question to Ted, feel free. Throw it in the chat. If you don't want to do it, we can ask Ted. Somebody must have a tough question for Ted. So Ted, the feedback on that peak to trough, can you just explain a little bit more around, the GTA numbers is coming in the end of, at the end of this month on the forecast. Like, I know this is really hard to forecast. Where do you think the GTA is gonna end up?
Well, as I mentioned, for most markets across the country, we're giving a best case scenario of 8 to 9% drop to a worst case scenario of an 18% drop, and so Toronto will be somewhere in that range. You have to remember that since February, and this is where sometimes it's nice to look at more metrics than fewer metrics, because fewer metrics, depending on who's showing those metrics, sometimes they may not be as representative as you would like them to be. The fact is that the trend price in Toronto is down 8%, right, since February. So a 8 to 18% range is not all that unrealistic. We're already down 8%. But as I say, peak to trough is only one metric. If you've been in this market for more than just 3 months as a homeowner, the average annual price change also matters. And there we're seeing the likelihood that we're going to see about a 4% increase in prices in 2020 versus 2019, just because we entered 2020 like a lion, with such strength that it's kind of skewing that average price up for the year. So I think that the speed at which this lockdown opens up, the ability to avoid a second wave, that's going to help expedite the recovery in housing, for sure. But again, nobody knows the timing of all of this, which is why scenarios are so good and so timely right now.
I think the month of June, Ted, is going to really show us how we're reacting to this pandemic. And I think once we see how the numbers finalize at the end of this month, we'll get a good handle of, hey, is this new world wearing masks to show how's the new norm? It looks like people are moving on. We're seeing traffic has increased in the GTA. You're just seeing more and more activity getting back to normal. And whether you're wearing a mask to show a house, it doesn't look like people are fazed by that. So I'm hoping the June numbers show us a very different story from what the forecasts were telling us.
Yeah, and as I say, let's not put too much weight in one monthly data point. Let's look at the trend, and let's zero in on the late summer, early fall, because that's going to be probably your best leading indicator of where this market is going. Keep your eye on some of those metrics that we've highlighted here.
Ted, thank you so much this morning for your great insights. It's just really good to have a good understanding, and we like putting you on the hot seat too. Is a lot of fun. So thank you so much for your time, Ted. And I thank everybody for joining us today.